Hello, my name is Sam Fankhauser, and I'm the director of the Grantham Research Institute on climate change at the London School of Economics. In this video, I'm going to tell you about two ways in which we can put a price on carbon emissions. The two instruments are first, a carbon tax and dividend scheme, and second, personal carbon allowances. Most policy experts, and certainly most economists, would agree that putting a price on carbon through schemes like those is absolutely essential for effective climate action. It makes the polluters pay, it forces people to consciously manage their carbon emissions, and it therefore changes behavior. So let's look at those schemes in turn. I will first talk about carbon tax and dividend, and then I talk about personal carbon allowances. So carbon tax and dividend. The tax part of carbon tax and dividend is straightforward. For every ton of CO2 that somebody emits, you have to pay a charge, you have to pay a tax. So when you choose between taking the plane or taking the train for a trip, say, from Edinburgh to London, you will have to pay for the carbon emissions that your flight emits. And because the train will run on clean electricity, that makes the train more attractive as an option. What about the dividend part? The dividend part of tax and dividend is what you do with the money that you raise. And the answer is you give it straight back to the households. Every household literally gets a check in the post, and that is the dividend of every household, the money they get back from the scheme. What are the pros and what are the cons of carbon tax and dividend? The main pro of a carbon tax is that they're relatively easy to implement. There's a lot of experience how environmental taxation works. And we know that it is effective at reducing emissions. We have examples, for example, from Sweden, from British Columbia, and other jurisdictions where such schemes are in place. The main disadvantage of carbon tax and dividend is that people don't like taxes. They have the suspicion that schemes like that are about getting revenue for the government rather than improving the environment. But that is where the dividend part of the scheme comes in, because the dividend part is an explicit commitment that the money gets recycled straight back to the households. And it makes clear that this is about the environment. It isn't about raising tax revenue. The dividend is also important to address the second problem, which is that most carbon policies, not just pricing policies, but other policies as well, are unfair. They hit low-income households more than they hit high-income households. The reason is that low-income households spend a larger part of their income on carbon-intensive things like heating and transport. But because the dividend is equal for every household, those who emit not a lot of carbon, either because they're low-income households or because they have cleaned up their carbon footprint, they actually get more money back than they put in, so they're better off. So that was the carbon tax and dividend scheme. Let's now move on to personal carbon allowances, the second scheme that I wanted to introduce you to. Personal carbon allowances are a form of transferable emissions quota. So they're a little bit like the quota that regulate the fishing industry. Carbon allowances would be allocated to everybody by the government for free. And each time you buy something carbon intensive, so if you book that flight from Edinburgh to London, part of your allowance gets used up. If you have spare allowances at the end of the year, you can sell that surplus. If you have a shortfall, you have to buy more allowances in. You will probably do that electronically. So you can think of your carbon account a little bit like your bank account, where you transfer carbon in and out. So what are the pros and cons of personal carbon allowances? The main advantage is that it's a very tangible way to force people to factor carbon into their decisions. each time you dip into your carbon account, you're reminded that emitting carbon is actually not a good thing. Like a carbon tax, the scheme we looked at before, carbon allowances reward people who emit small amounts of carbon, or either because they have a small carbon footprint or they have succeeded to reduce their carbon footprint. They get money from selling their surplus allowances, so they're again better off through the scheme. The main drawback of personal carbon allowances is that they're quite complicated to establish. They're complicated for the government, which has to set up a safe and comprehensive IT scheme, where everybody is covered and every carbon emissions are measured and accounted for, and that's complicated. They're also complicated for individuals who don't only have to juggle their financial affairs, they also have to manage their carbon affairs. And for a lot of people, just managing their finances is already difficult enough. So what do we conclude from those schemes that I have introduced to you? They're examples of how we can put the price on carbon. There are variations on those schemes, but they're good examples to show that you can use pricing instruments to change behavior, to reduce emissions, and to do so effectively and fairly. Thank you.